Now, our next speaker is Sid Norris. Sid Norris has been an active investor, trader, and student of the financial markets for over 30 years. Since 2010, he has provided market forecasts for subscribers at his website, ElliottWavePlus.com. Sid is best known for pioneering new ways to improve the accuracy and usefulness of the wave principle. In 2013, he started integrating Hurst Cycle Analysis into his Elliott wave counts with the objective of removing directional bias. Over the years, as his understanding of how to combine Hurst with Elliott evolved and improved, his subscribership grew substantially. Today, Sid is best known for taking Elliott wave theory to the next level by combining it with additional robust methodologies, thereby creating higher confidence and less subjective trading forecasts. Over to you, Sid.
Thank you, Jody, for that introduction. My name is Sid Norris. I am the owner and primary market analyst for Elliott Wave Plus. This is my website that you see on the screen here, my live website. So please go there and check that out. Elliott Wave Plus. Elliott has 2 L's and 2 T's. And you can read about me and my history and what I'm doing here as you scroll down and my different offerings and things. But the main reason here at the beginning of my presentation that I wanted to bring up the website is so I could show you a couple of things. One is you can use this Contact Us tab at the bottom of every screen at my website to send me an email. I'll have an offer that I'll present during today's presentation. The offer basically is if you've never subscribed before to my services, I will refund 50% of the first month of whichever level of subscription you decide to go with. But you would want to contact me first, either using that Contact Us tab before, and make sure that I'm aware that you are new and that you expect the refund, 50% refund on the first month. Or you can email me, sid@elliottwaveplus.com. So here at the beginning of the webinar, I wanted to bring up my terms of service or disclaimer. It's at my website. That tab is at the bottom of every page of my website. So please go there and read that in full. If I were to summarize it in one sentence, it would be, there's risk of loss in all trading. One additional thing I'll show you about my website is there's information about the different subscription levels. There's a bunch of testimonials. You can get to my YouTube channel and also my educational guides and blogs here. And there's information about the different subscription levels and what they cover there as well. And that is if you are not a subscriber. Once you are a subscriber and you log in, the headings up here actually change, and then you can go in and look, for instance, at my biweekly screenshots, which I'm trying to get it to go to. Hold on. Or you can look at the webinar recordings. I do a weekly counts webinar every Sunday. It's a very comprehensive look at the entire market structures. And then we have nightly reports for premium plan and trend plan subscribers, et cetera, et cetera. So that's just a quick look at what's going on at my website. Please go there and check it out. Today, I don't have any fancy slides or anything prepared for you. What I thought I would show you for the most part today would be live charts and a lot of the things that I show subscribers with all my services. First thing I'd like to start with is my long-term count on the Dow Jones Industrial Average. So this is 100 plus years of data. The Dow Jones Industrial Average actually started just prior to the year 1900. I think it was 1896. And Robert Prechter has published many books where he takes a lot of the European data prior to the U.S. and kind of pastes it on before the U.S. Chart. And so for a long time, decades, ever since he started counting waves, he's got the September of 1929 high as a super cycle wave 3. The July of 1932 low is a super cycle wave 4 low. And then all of the upward activity since the 1932 has been a fifth wave at super cycle degree, and therefore once the fifth wave completes at super cycle degree, we will have a grand super cycle wave 3 top. So we're not just looking at a potential small degree top up here from an Elliott wave perspective. We're looking at a very, very large degree top. And a couple of other additional pieces of information I have on this chart. I put where World War I occurred, World War II, Vietnam War, and during each of those wars, just as a little side note, the markets went up. And so during the many times, the market has a mind of its own. It really, even if something really awful is happening, it doesn't necessarily mean that the stock market's going to go down. There's many examples of that throughout history, and I've just got a few short examples here on this long-term chart. So up from the 1932 low, 1, 2, 3 at cycle degree in 1966, an expanding triangle for through 1974 for the cycle degree wave 4, and ever since 1974 we've been in an extended fifth wave. And if the and so I've got some Fibonacci targets that I've got in here. And by the way, you won't be able to produce these Fibonacci targets on your charting platform unless you have a not only Similog mode and a very long data set, but your Fibonacci tools need to work in Similog scale. So if I put the Similog or the Fibonacci targets and I take them out of Similog mode, it changes all of the targets substantially. So the Fibonacci tools must use Similog math when you're on a Similog chart, or you're just not going to be able to mimic these targets. So if the Dow Jones Industrial Average hits 41,020, which it has not hit yet, then the entire move up from the 1932 low through that high, if you take that entire distance, the 1974 low will cut that entire move by the golden section. In other words, the very extended fifth wave will be 1.618 times the net traveled of 1 through 4. And we've come pretty close to that target so far, but haven't hit it yet. So what's happening since the 1974 low? Well, we got a primary or burgundy wave 1, 2, 3, and 4 through the 2009 low. And then this, everything up from the 2009 low has been a burgundy or primary degree wave 5. I have found that the very most common target, Fibonacci target to the end of a fifth wave, is where the fifth wave will be equal to the net traveled of 1 through 3 times 0.618, and that is at 41,981. And that also is a target that has not been hit yet. And then finally, up from the 2009 low, we would need to see a clean 5-wave structure with all the subdivisions in place, and I don't think we have that finished yet either. And let's see here. I want to bring up the chat so I can see anything that's happening on the chat. So the subdivision's actually been relatively clear, moving up in black or intermediate degree 5 waves up from the 2009 low. And so for that, I'm going to move to a monthly chart. And the reason I'm showing you these wave counts on real early here is to show you that I don't think the market has topped yet based on Elliott wave and its best Fibonacci target. So up from the March of 2009 low, 1, 2, 1, 2, 3, 4, 3, 4. That's down to March of 2020. And then this movement up since the March of 2020 low needs to be a 5-wave structure. And it really should move end somewhere in this Fibonacci target zone. By the way, on this chart, I'm showing you where wave 5 in black would equal the net travel to 1 through 3 black up from the 2009 low times 0.618, and that target is at 43,652. So we're in an extremely extended 5th wave at cycle degree, but looking for a normal, the end of a normal burgundy or primary degree wave 5 and a normal black or intermediate degree wave 5, and it creates a very tight Fibonacci target zone between 41,020 and 43,652 on the Dow. Notice that I have some dates that I have on this chart, and those are created by a program that I use extensively. It's called Sentient Trader software, and it's something you can purchase if you wish. Those dates come from Hurst Cycle Analysis. Now, admittedly, up from this 2020 low, I'm counting a very brief 1 and 2 down here that looks a little weird. I'll admit that. But I don't see a completed 5-wave up structure to the peak yet, even though Robert Prechter and his organization, I believe, and I'm not positive, I'm not currently a subscriber, but I think he's wanting to call this the grand supercycle wave 3 top that occurred back here. But personally, I don't think that it topped there, because there's very little Fibonacci cluster support for that peak at that time. So this is a weekly chart. So you can see I'm moving closer and closer. This shows a main and alter. The main count is my wave count that we're going to move up and top in this Fibonacci cluster that I've been showing you sometime late this year, probably in October. The alternate is I'm tracking Prechter's count in my alternate that the grand supercycle wave 3 top occurred in the early days of last year. And so I'm keeping both a main and an alternate on the chart. There's a reason I'm going through all of this, and that's to show you that it doesn't matter in your trading. It shouldn't matter in your trading whether or not you believe Prechter is right or whether I'm right with my wave counts. And I'm going to prove that to you here in just a second by showing you this, a bunch of excellent trade calls that I've made over the last year on the S&P. And I've been continuing to track both Prechter's call and Prechter's count and my count all along the way. So my main count is that we've got a 1 and a 2 back down here in blue. And so we need 5 blue waves up from the March 2020 low in order to call a peak. And then I've got the wave 3 top actually occurring in August of 2021. And then all of the movement down that occurred during the first 3 quarters of last year, first 3 quarters, was corrective. It was essentially a WXY or potentially the ABC pattern. And I get that all the time, and I don't care, Richard, if you don't agree with my wave count, and I'm going to show you why it doesn't matter. Even if Prechter's right, this would be a leading diagonal for 1, and this would be an ABC to the upside, ABC. And therefore, this move to the upside in Dow Jones Industrial Average would need to, from this in Prechter's count, would need to be a 5-wave structure to the upside. And so what I do is I integrate Hurst Cycle Analysis into my wave counts. And I think that it's quite likely that the October low of last year was an 18-month cycle trough, and we're in essentially the last 18-month cycle within a 4.5-year cycle that is due to bottom in April or somewhere around the mid 2024. So during this period right here, we might make a new high or we might not. I don't care. And therefore, I'm going to keep moving into shorter and shorter charts. And now you can start to see what's happening with Hurst Cycle Analysis. Now, I can't teach you everything about Hurst Cycle Analysis in a few minutes, but if this is an 18-month cycle trough, the October low in Hurst, then moving forward from there, you start with an 80-day cycle and then another 80-day cycle, and that creates a 20-week cycle trough. So a 20-week cycle trough is due in approximately late February. Now, admittedly, this upward movement in the Dow Jones Industrial Average really isn't impulsive. This upward movement that we've seen since this last 80-day cycle trough, that would have been just a few days before Christmas. And but Hurst has been calling for this downward movement. And by the way, in the markets right now, today, we're seeing a very bearish day. And this, I haven't changed this chart. This is exactly what I sent to my subscribers last night, that I was looking for some pretty substantial downward movement in the Dow Jones Industrial Average next, down into the next 20-week cycle trough. And then the market is, Hurst is bullish next through April 1. And really, the composite line is bullish all the way. And I'll show you what the composite line is on Hurst. This is a live chart of the S&P, and it projects what's going to happen next from a cyclic point of view. And this composite line attempts to kind of predict where price is going to go moving forward based on the analysis. And you can see that it generally works its way to the upside through late in the year, but on the very short term, it's been calling for this downward move into this 20-week cycle trough, and then upward movement next through April 8. Okay, and that's for our talking purposes here, that's all we really need to know. So next, I'm going to move to essentially the same chart, but on the S&P. So this is my main and alternate wave counts on the S&P. Now I've noticed a bunch of people wanting to chime in, claiming that Prechter is correct. But let me ask you something. If Prechter is correct, and this was as high as the stock market's going to go in our lives, how has that, even if that's right, how has that helped you profitably trade these choppy overlapping waves that we've seen ever since? And the answer is it means nothing. It's what it does is it gives you a bias. And I'm telling you, you can trade these markets, and without that underlying bias, you can trade it profitably both to the upside and the downside. So I'm going to keep this live daily chart up here, and I'm going to show you some of the calls that my service has made for my subscribers. And the first, I'm going to bring up a screenshot that this is exactly what I sent out to subscribers. And this screenshot is dated, was on June 15. And you can see that on June 15, I was expecting one more slight new low to complete from this high here, a 5-wave structure to the downside. And Hurst was expecting that in mid-June, we would get an 18-month cycle trough at that time, and that it would rally out of that low. So that was on June 15. So I'm going to take that as put it aside. And you can see that that was right here, and 1, 2, 3, 4. Yes, there was a 5th wave down. It was very quick and sharp, and that bottoming date there was June 17. So I was bullish out of that June 17 low. So the next screenshot I'm going to show you is a screenshot from this one's dated, that was sent out to subscribers on August 14. And you can see that I was expecting a peak on August 14, and then a multi-week, potentially a pullback that would, at that point, was looking for at least about 1 month of downward movement. So I was suggesting, hey, we've hit a Fibonacci price target. We're very close to the 200-day moving average on this daily chart. I'm looking for a pullback, a multi-week pullback from there. So that was on August 14, and the market peaked on August 16, right here. And then moved to the downside, actually, for a little more than a month, almost 2 months. And notice that the wave count, as we moved along, I was originally thinking this was the end of blue wave 4, but this would be the end of, and now I'm thinking this was the end of blue wave 4, and it doesn't matter what my wave count, main and alternate, really were, because I'm showing you how the value of Hurst Cycle Analysis right now. So the market bottomed on exactly October 13, right here. So here's the October 12 screenshot. Whoops. October 12 screenshot that I sent out to subscribers, and I was expecting there might be a slight new low down here, and I had a Fibonacci target. The best one was somewhere between 34.91 and 35.16, and they were expecting a large cycle trough and a bounce up out of this, out of that low. So I was suggesting that we were within a day or two of a bottom. Well, that ended up being perfect, as there was a plunge, and we ended up seeing that the screenshot was on October 12, and the bottom came in on October 13, the very next day, and it reversed very strongly out of that low, as I suggested. And then we had a rally. And the next screenshot I'm going to show you is the one from December 14. And on December 14, I was suggesting we were going to get some downward movement down through approximately December 23rd, maybe a couple days before Christmas there, and that there was a whole bunch of seasonality and other situations that were actually not seasonality. Seasonality was not working well at that time, but was looking for downward movement through approximately December 23. We're looking for an 80-day cycle trough at that point. Well, it moved down through December 22, and then bounced. And you can see, and if you go back and look at the recording of this, you'll see that I was gradually changing my wave counts a little bit, but the most important thing was that I was right ever since the middle of the year on pretty much on all these turns on the direction of the market. So even if we didn't get, like, for instance, a giant wave 3 up from that low, the direction, and that's what Hurst Cycle Analysis predicts. It doesn't predict price, it predicts direction. So this is a short-term chart on the S&P, and it was projecting we were going to move down next through approximately February 27. Well, we're getting this huge down day today, and a lot of people would say, oh, well, that's because the PPI, the inflation, came in real hot. Well, if you look at a live chart, and for that, I'm going to bring over my personal trading, where this would be, if I can get it to go over there, Thinkorswim, and was projecting that last night, even though there was a ramp going up into the close, that we were going to see a downward movement next through approximately February 17, and that's based on a very short-term chart, and that we were getting a leading, expanding diagonal to the downside. And so, yeah, the market looks like it's wanting to pull back up just a little bit here, but I don't think that's going to, it's just going to be a partial pullback, and then we're going to move lower. On this daily chart, you can see the projection of an expanding leading diagonal for A and B, and then this C wave that moves much deeper down into late in the month, and that's the projection, the live projection. Question came in, what software is being used on these charts? Well, I use Genesis Trade Navigator as my primary charting platform as far as showing my wave counts and everything else. I also use Sentient Trader software, Sentient Trader for Hurst Cycle Analysis. So, and notice that I've been keeping a bullish and a bearish roadmap all along, but Hurst has been correct on, no matter whether you think the top is in back here or not, on these swings. And therefore, it has been extremely helpful on assisting in profitable trading of the swings, no matter what the long-term wave count is. That's why I was saying early on, like that it really doesn't matter whether you've got Prechter's count or my wave count. So this is the benefit and the reason that I added Hurst Cycle Analysis to my work. So this is a screenshot from February 1. That was Fed Day. And if you remember, on Fed Day, the market was up. And I was thinking that based on, once again, on Hurst, that it would top and move down into late February, which this roadmap really hasn't changed that much really over this last several weeks, ever since the Fed meeting, that the Fed meeting would likely mark a top, and then we would move to the downside over the next, have a multi-week pullback to the downside. And so that is still my projection. So and then there's the 240 minute chart. And so my roadmap is working beautifully well. It's down through February 17 on the short-term swings, up through Feb 23 approximately. These are always approximate dates, and that's why we have to look at Elliott wave and its associated Fibonacci price targets, but generally looking for a pullback down into this 20-week cycle trough. So that kind of shows how accurate my work has been. And in recent times, and I wanted to show you some of the additional things that we use besides Hurst Cycle Analysis to look at what's going to happen next in the markets. So one thing that I pay particular attention to is a kind of a custom indicator that I've programmed where I overlay the money flow index, which is essentially an RSI that is weighted by volume. And I overlay it on top of a standard RSI. And what I've found is that when the money flow index is sloping to the upside and the RSI is also sloping to the upside, and especially if they're coming up out of oversold territory. If the money flow is moving above the RSI, that is bullish. That means there's a lot of volume coming in, and it really helps you pinpoint times when you're going to see some upside continuations. Whereas over here, we've been getting warning sign from that very same indicator where it crossed over and moved below the RSI right here. And you can see that was a warning that we're going to see downward movement. And notice that it is still lagging. The money flow indicator is still lagging the RSI. And so my wave count basically calls for some more downside pretty much through the end of the month. And then another item that I am extremely proud of is most of my subscribers are either money managers or they are professional traders. And many of the professional traders that are subscribers, we've become friends over the years. And most of my subscribers have been with me for years and years and years. And some of them share a lot of what they've learned. And I had one particular subscriber recently that was a longtime student of Larry Williams. And when he started subscription with me, he knew very little of Elliott Wave, and he knew that Larry Williams wasn't really that big of a fan of Elliott Wave. And he didn't know anything about Hurst or anything, but he knew a lot about indicators. And if you understand Larry Williams' history, he is really a pioneer on how to utilize sentiment in your trading. And it was he and I kind of collaborated for really several years on the development of what I am calling my sentiment conditions screenshots. And I show my sentiment condition screenshots on dozens of items within my service. And on this, I have basically 4 indicators down here. And the first 3 are related to commercials positioning. So who are the commercials? A definition of commercials is an entity involved in the production, processing, or merchandising of a commodity. Commercials use futures and options on futures to hedge their business interests. A commercial trader may also be referred to as an institutional trader if he's employed professionally by a bank, brokerage, fund, or other financial firm. And so when you are trading extremely large accounts, you're considered a commercial, and you are required by law to report your positioning. And so this, I'm tracking with a fast, medium, and slow acting commercials positioning indicators down here. And then the bottom indicator I have down here is the daily sentiment index, DSI, which comes from a completely different source, and that's requires a subscription. But within Trade Navigator, I can actually chart that indicator, and what that shows is the current percentage of retail traders that are bullish. So right at the close last night, 67% of retail traders were bullish. So what this does is it kind of shows important junctures where the commercials are particularly bullish. Now, what commercials generally do is if there's a strong downtrend, they will build a position against a trend. In other words, they will fade a trend. And so moving down into that important June low, so as a reminder, back to the daily chart on the S&P, the June low is back here. At that low right there, not only was Hurst looking at a potential large cycle trough at a multi-week rally out of that low, but also from a sentiment perspective, the commercials were heavily long at the very same time as retail traders who are traditionally dead wrong, all over on the wrong side of the boat at major swings. They were heavily bearish. So only 7 and 9% of retail traders were bullish at this low, but commercials were all heavily long, and not with all of their positioning. That means as a percent of open interest, this is an actual Larry Williams indicator that he printed the code, the Trade Navigator platform code on how to put it into your chart in a book decades ago. And it is an attempt to speed up what the COT or positioning report is. And then this middle indicator is commercials positioning as it relates to their most bullish and bearish positioning over the last 6 months. And then the bottom indicator shows commercials positioning as it relates to their most bullish and bearish positioning over the last 12 months. So this is the fast, medium, and slow acting commercials. And you can see that we had what I call a perfect storm of bullishness at that June low. Retail heavily short, commercials heavily long, and we got a massive rally up out of that low that ended up topping up here around mid-August. The low in October was also bullish because we were getting those super low DSI or retail readings. Retail, the further down a bear market goes, the more bearish retail traders get. And then when you at that low right there, we had commercials as a percent of our commercials on the 6-month and 12-month look back all heavily long again. So that wasn't quite a perfect storm because this indicator wasn't in position, but it was close enough. 2 of the 3 commercials indicators were green, and retail was heavily short. So that predicted that there was going to be a rally out of that mid-October low. This also supported my wave counts and projections for an important low there. So what's happening right now? Notice that I also on the S&P am showing that we've been just now finishing up a little short period of bullish seasonality, but it's coming to an end. And notice the commercials as a percent of open interest are heading lower here. Commercials on a 6-month look back are about as bearish as they have been at any point in the last 6 months. And retail traders are fairly high to 66, but not at an extreme level. And therefore, because retail traders are not that hugely bearish, they're not up in the 90s or anything like that, that I'm expecting this to pull back here based on that, just on this chart. There's no Elliott wave, there's no Hurst on this chart. All there is sentiment and seasonality. So I'm expecting that pullback, but I'm expecting it to be a corrective pullback that won't last that long because retail traders aren't high enough for this to be a major top. Very quickly, as long as we're on my sentiment condition screenshots, let me show you. Let me make sure. I have one more thing before I move away from these screens. There's something I've been tracking, and that is I've been tracking. This is the ES futures contract, daily candles, and then I've got overlaid on it. I've got a bonds overlay. That's the purple chart. And I've got the US dollar index overlay, and that's the green chart. Now, the US dollar index here is inverted. And notice that the market has been trying to stay up while the dollar has been moving down. So it looks like, I'm sorry, the dollar has been moving up. A stronger dollar, and remember, this is inverted, is a major headwind for stocks. And it's no surprise today that we're seeing a downward movement. Also, bonds have been it's amazing how highly correlated bonds, the US dollar and the stock market have been lately. So what else looks like trouble on this chart? Well, this money flow index, you can see, is lagging the RSI. So there's the buying volume has been drying up ever since Fed Day. Also on this chart, I wanted to show on I call it financial propaganda TV. You get they're constantly talking about the Fed, and the Fed is the driver of the markets. Well, the Fed is not the driver of the markets. The Fed is lagging. The Fed always lags. And if you look going back into history, the Fed will adjust their interest rates to chase the bond, what the natural bond market is doing, with about a 5 to 7 month lag. So let's look at the effect of all of the raises the Fed has done since they started raising on March 16th of 2022. So on that date, they raised and the market went up for a couple of weeks. The next time they raised, the market went down for a couple of weeks. The next time they raised, the market went down for one day and then started a multi-month rally. The next time they raised here, you can't even, the market just continued to rally. The next time they raised was here, and the market went down for about a week, and then found an important bottoming region. The next time they raised, the market went down for one day and then started into a multi-week rally. The next time they raised, the market had peaked the prior day, and it went down for about a week. And then the next time they raised, right here, the market went up for one day and then started correcting to the downside. What this proves is that all of this talk on TV about the Fed is worthless to a trader. It has no meaning other than you can expect that on Fed Day, there will be a lot of volatility. And so the market will a lot of times take out any shorts or any longs that have stops nearby. They take them both out. And so they have to be prepared for that. But as far as meaning, what meaning can you give to that would be meaningful to a trader? And the answer is zero, and it should be ignored. And yet that virtually every talking head on propaganda financial TV will quote the Fed as being the reason why they believe this or the reason why they believe that. You take for instance the market today, and I'll bring over this short-term chart again on the ES contract. Well, that news announcement that PPI came in real hot, it came in right here during that candle. Notice that the overnight, the futures had been moving down into that announcement. They were already moving down. And so there's no way you can say that a news announcement was the reason why the market moved down. It was already moving down. So let me look at my notes here. I wanted to show you some of the calls I've made and how it doesn't matter what the Elliott wave count was. The Hurst, his major assistance when it comes to swing directions in the market. And I've also showed you how I incorporate sentiment. I'm going to show one other sentiment conditions. Screenshot. I'm going to show it to you on gold. And by the way, my premium plan subscribers, they get my sentiment conditions screenshots on over 24 items every night. And I will say that one of the best items to track when it comes to sentiment is gold, because gold is a very highly emotional item for a lot of traders. A lot of traders believe that gold is it's a safe haven in case of a stock market crash. Frankly, you go back in history and that's not really true. Gold is, though, a tradable thing, and it's amazing how well my sentiment conditions template has done in pinpointing in important junctures. So if you look at back in March on gold, that was at this high right here. So notice that I was thinking this was a terminal thrust up out of a triangle. And therefore, when it was finished, that was the end of the road on that pattern, and there would be a substantial decline. And man, there was a huge decline from the March 8 high down to the November 3 low in gold. And amazingly enough, that was during this period where we're having relatively high inflation. So when we go to the sentiment screenshots, one day after the peak in March, my sentiment conditions, we got our first red candle there. By the way, the color of the candles is associated with a smoothed DSI indicator. Notice that we had a 95 reading on retail. So 95% of retail traders at that top tick were long. And look at where the commercials were positioned. They were heavily short. That is about as perfect of a bearish storm as you're ever going to see. And when the smoothed DSI indicator started sloping to the downside, it started coloring the candles red. And so the one candle after that peak, it was firing a bearish signal. And something else, notice this brown or tan area, that means that the ADX indicator was over 60 on a daily chart moving into that high. So this not only pinpointed the top within one day, but it was warning ahead of time that we're at a very important juncture for a major top. So how about lately? Did it give us any nice bullish signals? And the fact is, yes, it has. Look at this November 4 candle. So the gold actually the low tick for the year was on November 3. We had commercials heavily long, all three measures, the fast, the medium acting, and the slow acting, at the same time as we had the DSI at a 15, and the DSI was had hardly climbed at all ever since it was into single digits back in here. So most of the retail traders were tremendously bearish at that time, and that was a perfect storm, and you can see what happened there. So what's happening recently? Well, I was warning my subscribers of a top in gold ahead of that top tick, because commercials were showing that they were hedging. In other words, the gold mining companies, the producers of gold, were afraid that this had run too far, and they were hedging against lower prices. That is a major warning sign. Retail, on the other hand, had recently seen a reading of 92. Amazingly, gold managed to scrape its way a bit higher for several more days after that 92% bullish reading on retail. But it was a warning sign nevertheless. And then within just a little more than a 24-hour period, gold dropped $100 an ounce. In other words, had a person seen this warning and gotten out here, it only took about 2 days for gold to move lower than that. When it finally peaked, it only took 2 days. And that's the sort of price action you see in a highly emotional, highly reactive price action you see in gold. And I guess the bottom line is my subscribers have been afforded these amazing information about where the most important junctures were to get long or short on gold. And all the rest of the junk talk about gold, is it a safe haven? Is it the place to be in times of inflation? Stuff have been meaningless in comparison with the accuracy of the signals that are coming out of this, my proprietary sentiment conditions indicator. And I've got these on lots and lots of the sentiment conditions on virtually all of the major, most traded futures contracts. Notice also that that we've been in a period of bullishness on gold. But and so a lot of experts, so-called experts, are just hot for bullish seasonality or bearish seasonality. They're hot for seasonality, but what seasonality really is you take about the last 20 years of data and you average the price action into a composite line, very similar to what Sentient Trader does. It comes up, it averages what all of these different cycles, over 20 cycles, and which ones are pushing up, which ones are pushing down on price. It takes an average and it comes up with a composite line that projects movement. Well, that in seasonality, that's a composite line of the last 20 years of data, each year's data giving equal weight. Well, its seasonality is very rough. I think it's the least meaningful of all of the technical tools that are being shown out there, but there's still a lot of people are hot for it. But this chart just proves that it is in fact sentiment that by far should be given far more weighting to your positioning and your trading than any kind of seasonality. Let's see what else I need to show here. Oh, I was going to show one other thing, and this is back to, I'm going to go back to the Dow Jones Industrial Average very quickly. Oh, I will show you on bonds that we are nearing here late in February, likely an important juncture when it comes to sentiment. So one of the things we promised is that we would show you some of the best items to be looking at right now for trades. And this is the ZB contract of Treasury bonds. And notice that seasonality has been bearish here recently, and we've certainly been moving down in keeping with the bearish seasonality, but also in keeping with some downward movement that's been projected on my main wave count with the assistance of Hurst Cycle Analysis. But coming up here, we're going to be entering into a period in late February of bullish seasonality. And notice that the commercials are all heavily long on bonds. They think bonds are going to go up and yields down. So we're nearing a potential juncture where we're going to see a resumption of the uptrend in bonds, and therefore the downtrend in yields. And then very quickly, I had showed my everything I'm thinking about through the Jay on equities, generally bearish through most of the rest of this month of February, and then the month of March, bullish. I'm going to go back to the Dow Jones Industrial Average very quick, and I'm going to explain one other thing. I only have a few. No, I don't have any more time. I'm out of time. It is 9:59. I'm out of time. I'm going to go back to very quickly on the Dow Jones Industrial Average, and I'm going to show you that very quickly that one of the things they're talking on television is the bond inversions, where the short-term bonds are paying a higher yield than the long-term bonds, and that is traditionally a signal that you're going to get a recession. And that's correct. That is a signal. But however, there is about a 6 to 18 month delay that occurs from the point of the inversions. And back in 2006, bonds started inverting in the first quarter of 2006, and the market didn't top until October of the following year. That was a full 18 months later. I think we're going to get very much the same thing this time. That would allow for a potential movement up into my target zone on my wave count, a final blow off move, and then the recession come in at about an 18 or possibly even a 2-year delay from the point that the bonds were inverting. So I still think that we're going to get that recession, but it's that they talk about it constantly on TV, but it is such a blunt instrument. It's not good really for timing. So that very quickly, my email address is, I'm going to change this on the chart here, sid@elliottwaveplus.com. Send me an email. Let me know, hey, and go to my website, look at the different services, levels of services. If you have any questions about them, just send me an email. I'll give you a refund of 50% off of your first month if you are a first-time subscriber. So Jody, are you there?
I'm here, Sid.
Okay, and thank you for inviting me, and I will stop sharing now.
Just a second. I just want to thank you. Your presentation was just fantastic. I loved it personally. I love your sentiment indicators.
Yeah.
I loved everything you said. So
thank you.
Yeah. So Sid's offer is on the elliottwavehub.com/forecasting event. I'll post it. And thank you, Sid. And I hope you'll come back in the future.
I would love to. Thanks. Maybe next time we'll see. Okay.
Okay. I'm just going to stop the recording.